Okay, so now you have some idea of cap table, investments. You probably wonder, how do I determine the pre-money value of my company? If your company has a stable and predictable revenue stream, calculating the value is relatively straightforward. However, if you're a startup company, there is no established method to fall back on. Nonetheless, you need to determine a price. Here are 4 methods to consider. First, there is the Burkers method. The idea is simple. The value is calculated based on 5 topics: ID, technology, team, partners, revenue. Each topic is separately valued between 0 and 500k, non-existing is 0, completely ready is 500k. This leads to a maximum worth of 2.5 million. Not ideal, but it gives you a basis to discuss the price on. Our next example is a bit of an odd one, but good to know, the venture capital multiple. It's odd because you will not discuss this method with a potential investor. This method is a rough calculation that investors might do to check if your numbers add up. With this method, you check the exit values of similar companies as yours and the exit goal of the investor. With a few assumptions, you can estimate the price you can set for your company. For example, let's assume the investor invests 1 million and wants 10 times their investment back after a potential exit period of 8 years, which is usual for pre-seed rounds. We also assume that 3 more investment rounds are needed after this one, with a dilution of 25% per round. Finally, we assume, after doing some homework to back this up, that the exit value of similar companies is about 100 million euros. Now, as shown in the calculation, you can pause the video if necessary, but I'll shortly walk you through it. 100 million exit divided by the return on investment of 10 times makes 10 million. That, diluted by 25%, for 3 investment rounds makes 4.2 euro post-money. Finally, deduct the investment of 1 million and you end up with a 3.2 million pre-money. Hence, the pre-money value should be around 3.2 million euros. If you set a much higher pre-money value, the investor may conclude that they won't reach their goal and it won't fit their strategy. Good, enough on that one. Let's move on to the third method, the milestone method. The milestone method is similar to the last one, but focused on your perspective. It is based on 2 questions. 1. How much money do you need to get to the next preferably big inflection point or milestone? 2. How big a share of your company are you willing to give up for it? This is again in line with how investors think. Invest money, let the company do the work to increase its value, and continue to the next investment round. As an example, say you need 12 months to reach the next milestone and 6 months to raise the next round. Let's assume this would require 1 million. A usual round will likely have between 15 and 30% dilution, depending on your negotiation skills and the interest from investors. Let's assume 20%. This means that 20% of your company equals the investment of 1 million, which you need. So the post-money value is 5 million, which makes the pre-money value 4 million. You can use this to toy around a bit with the impact of different percentages on your money values, giving you an idea of how low you want to go. Save the best for last, which is the benchmark method. How well did your sister company do under similar circumstances? This method is, in our opinion, one of the best value strategies you can employ, as you can refer to real numbers that came to be in more or less the same circumstances. And the steps are simple, though the work less so. 1. First step is to calculate the range of your goal pre-money. The next step, you visit websites like TechLeap.nl, Crunchbase and other similar websites and look for comparable companies in your price range. Third step is to list all the arguments per company you can think of why this company is relevant to compare yourself to it. Think of the same tech type, the same market, the same country, same stage, same tech provider, etc. In the end, you have to convince the investor why this company is relevant. And finally, in the last step, you average the numbers and you have your price. This gives you a strong position because now the investor needs to explain why they deviate from the market, if they intend to do so. And with this last step, we have completed the picture, your funding strategy for the next few years. We have a funding strategy for the next 6 years of your company. We have a set of milestones during that period. We have identified the accompanying funding stages and the corresponding investors. We have identified the investment cycles. We've generated some ideas of FTE, required funding, valuation of the company at those stages. And we have some idea of what happens with your share in the company. Before we finish, we do want to draw attention to an important point. When you are doing these exercises, please focus on the value and not on the percentages. If you need to dilute a lot, but your company's value increases exponentially, it might just be worth to do so. In the end, after all, you're better off owning a little part of a lot than a big part of nearly nothing. And as with everything, there is a certain balance in things. Hanging on to the percentages too much will slow down the growth of your company. Letting them go too much will increase growth but might impact your involvement. So when doing this exercise, think for yourself, for your team, where you want to end up, where you are happy, where you will be motivated, and make sure that your strategy fits that goal. I hope that you learned from this talk and enjoyed this tech transfer video. My name is Rolf Segers and I'll see you in the next